Usually this would be the point where I would say hit it and Patrick would start the show. However, I have some sad news. Our dear friend Morris Sachs passed away this weekend. Morris was a Wall Street titan, from facilitating Paul Tudor Jones' famous 5-year Treasury note trade during the 1987 crash through his basis trading, to his eventual running of the fabled Greenwich Capital desk during the wildest years of fixed income. Morris did it all. But not only was Morris a great trader, but he was also a wonderful human. He was a kind, giving person, but always quick to laugh and truly understood what was important in life. It was my great privilege to call him my friend, and I will always cherish the time we got to spend together. I am a much better person because of it. Actually, we are all better off for having Morris in our lives. This weekend, as I re-listened to his appearances on the Market Huddle, I was struck by how much I enjoyed talking to him. His quick wit, the colorful stories, and the loads of wisdom made the time fly by. It was difficult to pick one segment to share with our listeners, but I finally decided on this one that encapsulated Morris's philosophy about trading and life too.
Not to sound too cerebral, but the whole dynamics change. Now, you've got kids, and think about the iPhone or the iPad versus when you were growing up, right? And
Yeah.
So it's the attention span and the way people process information, it's entirely different. And that's why I said, for me, getting away from the day-to-day tick up, tick down has been a tremendous advantage. So you met my good personal friend and former colleague, E.G., at dinner, right?
Right.
Okay. So E.G. is about 8 years younger than me, and he sat to my right, and he came in to help me out when I got promoted to trade the foreign stuff. And the guy is smarter than me. He's a better trader than me. He's got me beat hands down. The one thing I kept telling him after a while, though, is stop doing the trading, get somebody to do the trading, and you sit back and you do the thinking, because the money's in the thinking. It's not in the trading. And, finally, he's done that, and, he's always been very successful, but I think he's flourished in this new type of role. And that's the thing for the younger people. I mean, look, you and I both know there's nothing more fun than banging shit back and forth and writing tickets and getting that endorphin rush, right? I mean, or dopamine,
a trader's got to trade.
Yeah. I mean, even I like doing it, but when I'm talking about not like my trading amount, but like the portfolio, the bigger picture stuff, it's gotten much simpler when you're not logged into every little tick. And I don't know. This is where Liam would get me back in terms of what did you ask me? I have no recollection.
It's all right. You know what? Actually, you mentioned EG. You mentioned the big money is in the thinking, and one of one of your skill sets that I think is so uniquely great is your ability to manage traders. And I reached out to one of our friends, and I got some questions that I wanted to ask specifically about that, because I think that there's a lot to be learned about your process and your thinking behind it and how you were so good at it. So I'm just going to start, banging some questions that aren't even mine. There's somebody that knows you well that is probably in a much better place to pick these. So let's just go, and let's start with the first one here. When interviewing, hiring,
listen, I never touched her. I just want to make that clear.
All right. When interviewing, hiring, or inheriting traders from other managers, what qualities did you look for, and what surprised you over time, both positively or negatively?
Okay. I think the single biggest skill is a trader has to be competitive by nature. I've just seen too many people come through that have some sort of competitive athletic ability, and they more often than not tend to do well. I mean,
Really?
I feel like it's. I mean, people ask me why do I still do this? I still do it because, like, what are you going to do? Play Sudoku? I mean, or the crossword puzzle? I mean, what the fuck is the point of that? It's like, what a waste of time. You can sit here all day and you can, it's like a puzzle. And so I mean,
So
I don't know.
it's funny you say that because my wife is much better at word games than me. Like way better. She's better at. Well, she knows way more words than me. Her brain works better, and she hadn't played Scrabble, and she had never played. And I remember we sat down to play, and I instantly realized that I was going to get crushed in terms of the words. But I figured out there was a little bit of, game strategy that I could use in terms of blocking and doing stuff. And she looked at me and she says, "That's not fair. You're just playing to win." I was like, what the hell? Of course I'm playing to win. And it's constantly a source of, of conflict in our house is that I'm just playing to win.
Well, you should tell your wife that I won't even play Scrabble with my wife because she just crushes me, and I feel like a lesser person. So the fact that you leave her play it's admirable.
So I hung in there until she decided that she was going to use my technique of just playing to win, and now she crushes me. It's not even close. Okay, let's go on. What surprised you over time, both positively or negatively? Well, you mentioned positively. What was some of the negative things? Like what were some of the qualities that you got in terms of traders that you were like, oh shit, that didn't work like I'd hoped?
Yeah. Let me think of how to phrase this. So there's a certain, what's the word I'm looking for? Like I'm an old school guy. Even when I was in my 20s, like I was really caught up in the tradition.
Okay.
Like your word meant something.
Yeah.
And to me, integrity. Right. That's the big deal. And I've made this comment, and one of my daughters repeated it, which is a tremendously satisfying experience. So I break people into like two categories. Like, are they good people or are they not? And so an example would be if a person made a mistake and the mistake was an honest mistake, like, he tried to leg something, it didn't work out, he lost some money, or he had an idea, it didn't work out, lost some money. I had all the time in the world for that. But when people would come up with excuses or fabricate things, that put them in the bad person category. And once you went in that bucket, you were gone. I mean, I actually kind of lived my life that way. I've in the last couple of years, people that I've discovered, just don't tell the truth on stuff. I just cut them out of my life. It's a little harsh, but when you get to be a little bit older and you realize, there's only so many hours in the day, why hang with people that aren't honest, decent people? And it's not that hard to be honest and decent. You just have to have the character, right?
Right.
And so that's the thing for me with traders. I've got one guy, I won't mention a name, but he was with me for a long time, and he didn't make money every year. But he was always honest and an open book, and I had all day for that.
Well, Morris, my friend, we had all day for you as well. And we will all miss you tremendously. Our thoughts go out to your family, your friends, and everyone whose life you made sparkle by being a part of it. I know that Morris wouldn't want us to be sad, but rather remember him laughing and doing what he loved. So this show is for you, Morris. Hit it.
It's Friday, April 11th, 2025, episode 262. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back Peter Boockvar, Chief Investment Officer of Bleakley Financial Group and author of the Book Report, a financial newsletter on Substack. We have a terrific, engaging conversation about why the market was rolling over anyway, what tariffs are doing to the economy, and what an investor should do about it. And then in this topsy-turvy environment, lucky for us, Patrick has got his full set of crayons to make some sense of the price action in talking charts.
Well, Kev, actually, I had to pull out went from the 24 crayon set to the 48 crayon set because we're going to get serious here when we get to the talking charts. So later on. Anyway, folks, we're going to drink some beers here along the way. Danny, what beer am I drinking today?
Well, today you're drinking a Spanish beer called
Yes.
Aguilar, I'm going to say.
Yeah.
So it's an unfiltered beer, and it does say,
Absolutely.
before serving, turn the bottle upside down to awaken the suspended yeast and enjoy its full flavor. So have you...
Okay. Yes, I have.
Yeah.
That's
You
why
knew
it
you knew
exploded
to
into my
do
life.
that, Patrick? You knew to do that?
Yeah, well, I just did it.
And so for those who don't know that are just listening to this, Patrick has got a beautiful ocean view behind him. Patrick, where are you like the jet set traveler today?
Yeah, I'm in Mallorca, Spain. I'm on the island. I'm visiting some friends out here. It was an easy hop for me from Lisbon, so out on the island. But I was in the beer store. I'm like, what beer am I going to drink? And I saw these Stubby. And it reminded me. I said, listen, if I'm going to grab a beer, I'm going to grab the Stubby.
100%. Bob and Doug McKenzie.
Yeah, absolutely. And so basically I said, I'm going to do it. And it's actually not bad.
Patrick, just so you know, by the way, while you're sitting there on the ocean enjoying the warm weather, it's snowing back home.
Yeah. My sister sent a picture. It was, it's awful.
All right, let me do the side effects here. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the short squeeze spasm, the bond burnout disorder, and the gold rush rash. We probably have all three of those, Patrick.
I'm suffering here. It's
all right.
All right, let's get to the guest.
It's our great pleasure to welcome to the show Peter Boockvar, the Chief Investment Officer of Bleakley Financial Group and author of the Book Report, a financial newsletter on Substack. Peter, great to have you back, buddy.
Thanks for inviting me, Kevin. It was a good opportunity.
Oh man, it's great timing. We chatted a little, I guess it was a couple months ago, and we booked this, and we didn't know what time it was going to be, and it ended up being probably one of the most exciting periods ever in terms of kind of macro trading. And let's just start with that. Do you think that this is just as exciting and just as important in terms of the change as the great financial crisis and the dot-com bubble or the 1982? Is it up there in terms of, in your mind?
I think it is, in terms of the changing complexion of the market and the economy.
Okay.
So, sort of like you ride that economic wave of growth and then you sort of hit the wall. And all the instances you brought up, we hit a wall for whatever individual reason that was. And it seems like we're hitting another wall. Now, how high or thick this wall is compared to the others, we'll have to see. But my first impression is it's pretty high and pretty thick.
All right. So why don't you walk us through in terms of, do you think that this was, let's just start with, do you think this was the plan all along, or do you think that this is haphazard, like buckshot going on? What is your view in terms of how this is unfolded in terms of the tariffs?
Okay, because I we'll get to this. I'll talk about tariffs.
Okay.
But I want to get to that. There was a vulnerability building in the markets before tariffs even hit.
All right, let's talk about that. Let's start with that.
Because this is not all tariffs. There are a couple things. Valuations don't matter until they do.
Okay.
As we know, as longtime market participants.
Yeah.
But we came into the year trading it in the S&P 22 times forward earnings.
Right.
And just context for people, in March 2000, the go forward 12-month earnings, or I should say for full year 2020, we were trading at 24 and a half times earnings. So we were as stretched as can be on a price to earnings basis. On a price to sales basis, we were well above, and we had been well above those March 2000 highs. Also, at the end of last year, I would say the latter part of last year, kind of post second quarter tech earnings, I think questions started to be asked on AI tech spending. Now, we know what helped to bring the market off the mat in October 2022 was the AI tech trade. Basically gave the markets a second wind, in addition to the Fed beginning the slower pace of their rate hikes, which eventually ended, obviously, with no rate hikes and then eventually cuts.
Right.
So last year, I think the Mag 7 trade had started to splinter. I mean, you had Microsoft, for example, that was spending so much money that people were realizing that we got to cut our cash flow estimates, and waking up to the fact that this is actually now becoming a very capital intensive business.
Right.
And fast forward, the DeepSeek news is what I think really hammered people and officially killed the AI tech trade. Killed it in terms of its exceptionalism and its ability to lead and dominate the market. Where at its peak, these 7 stocks made up 35% of the S&P, and you add 3 more to get to a top 10, you're talking almost 40% of the S&P. So if you lose that leadership group, then you have to immediately pass the baton on to something else if you're going to maintain the level of market growth that we saw. Now, it wasn't just DeepSeek. I mean, well, DeepSeek, of course, proved to everybody that US tech is not the only dominant player in this space, that all the hundreds of billions of dollars over a multi-year time frame is going to build a commoditized product. And while it is a great technology, well, the history of technology is a new technology that helps us become more efficient and productive and so on. So I do think that the benefits of generative AI, using that specifically, now from here accrues to us being businesses that can integrate it into our companies to make things easier for us to do, and us being, a household that can use it in terms of, planning our groceries, for example. So that, I think, was the first big thing. And even within the Mag 7, you had people now questioning the Google search business because of the competition from ChatGPT and other models and other and Perplexity and businesses like that. Apple, trading at 33 times earnings, didn't get the the Apple Intelligence upgrade cycle that everyone was hoping for. And there's basically no growth there. And why am I paying 33 times earnings? I think that was a major factor. Tesla, of course, their auto business is shrinking, and you have all the distractions that Elon Musk has. Amazon, as great as a company as it is, it's still subject to the whims of retail spending, and we know the fragility in that when you sort of slice the upper income from the lower to middle income. So there are a multitude of things that I think have ended this trade. Again, all great from here, but I do think that they're entering sort of a wilderness that they haven't experienced before, and that is going from a growth stock to a value stock, and that could be a very long multi-year experience that PE multiple shrink, growth rate shrink, and they just don't lead the markets anymore. So you had that.
Okay.
Then you started to have questions.
Actually, one second before, do you think that we would have rolled over on its let's just assume that Trump does status quo. Do you think that we were rolling over and that the market was in trouble regardless? Is that what you're implying from that?
Yes, and the economy as well.
Okay.
So I'll shift to the economy quick and then go back to what I was continuing. So over the last couple of years, the U.S. economy has been resting on 3 pillars to its chair, not 4, but 3, and not even more than that. Upper income spending, government spending, and AI spend. Lower to middle income spending, these people have been in their own personal recession for the last couple of years. Government spending, whether it's through healthcare, where they've, because every dollar that's spent by the government ends up in the private sector. And government fiscal largesse, where we obviously know where the U.S. budget deficit went, that flowed into expanding corporate profit margins and corporate profits and economic activity. whether it's Medicare, Medicaid reimbursement payments going to healthcare providers, whether it's via legislation on the CHIPS Act, the IRA, infrastructure spending, or whatever, transfer payments, PPP, whatever this all was. It was an extraordinary boost to growth and earnings. And if you take out tech spending, ex AI, it's actually been shrinking, and capital spending in totality. If you look at non-defense capital goods non-defense orders ex aircraft within the durable goods numbers, it is essentially flatlined for the last couple of years. And then on the flip side, we've had a manufacturing recession. The U.S. housing market's basically frozen. I mentioned lower to middle income spending. Global trade has been very muted. And the labor market, the pace of hiring has slowed, even though it's still okay. Pace of firing still very low, but very much a mixed bag, which you have to look underneath the 2.5% GDP growth rate we've seen, give or take, over the past year to really understand that. So going into this year, you lose the AI tech trade, you have vulnerability in the stock market. That, I think, was going to continue because we were going to see slower earnings growth anyway this year relative to last year. And so all of a sudden you have threats to the stock market. The stock market and the economy are tied by the hip. And yes, on one hand, the stock market is sort of discounting expected weakness in growth, but the weakness in the stock market then exaggerates that weakness in growth because it negatively impacts upper income spending. Then, of course, we know we have DOGE and we have the plan to slow the pace of government spending, which that in itself would be a drag on GDP growth and a drag on earnings and the expansion of profit margins. I mean, profit margins didn't go like this for many decades and then all of a sudden like this out of nowhere. A lot of this was government spending. It was low interest expense. It was low labor costs. Well, we know interest expense is going higher when you compare it to 2021. Government spending now no longer that boost to the same extent as it was. And then labor costs. I mean, labor is gaining a little bigger share of that profit pie. So to me, there was vulnerability. And then, of course, okay, now the AI spend on a sequential basis, it's very difficult to sustain that. So the economy, I think, was on very, very shaky ground going into the tariffs. Then we get to the tariffs, of course. And I wrote the other day that I need to buy a whiteboard because to write in what's going on and then to quickly erase what's going on. Not just, the tariffs that we have on others, but tariffs that are threatened on us. So it's a total mess. And I'm coming from the background of the sort of the Rand Paul view that I support deregulation, extending the tax cuts, slowing government spending, even though it's going to have a negative short-term impact. It's what this country needed because we have been drunken sailors for way too long. But I think, and I said this back in 2018, I criticized Trump. I criticized Biden for keeping them on and adding to them that I understand their thought in using the tool of tariffs. Now, it's obviously been an array of things they want to correct with tariffs, but we don't have to go that far back in time to see what the historical impact of it was. If tariffs were so great, why isn't the U.S. steel and aluminum industry robust from the 2018 tariffs? If it was so effective against China, why is our trade deficit with them even greater? And I do have to also say the problem here in this whole discussion is there is this flawed and completely economically ignorant belief that a trade deficit is bad. I just got my hair cut 3 hours ago. So I actually have a trade deficit with Nicole, who cut my hair, because I paid her. Yes, and I haven't. She hasn't paid me yet for anything because she provided a service to me. I haven't provided for her. So I have a trade deficit with her on the services side. So does that mean that she's ripping me off? No, I think she's pretty reasonable in what she charges me. And I actually even gave her a tip. So in Trump's mind and Navarro's, that's a bad thing. And somehow she's ripping me off. So this whole belief that when you have that with another country, it's a bad thing. And of course, the huge trade surplus of $300 billion that the U.S. has with the rest of the world. Somehow we're not ripping anybody off, and it's just that's sort of put to the side. Bottom line is they want to recreate the 1950s. They want to bring all the manufacturing jobs back to the US, which I get is a nice thing to say, but it's just not economic reality. And yes, countries outside the US have tariffs that are higher than we have on them. Yes, let's try to sort of even that out. And I'm not defending China as being this honest actor, but you know what? Life is not fair. The world is not fair. Not everyone's going to do as you like, but we still have to trade with countries because it benefits us just as it benefits them. And if it benefits them, that means it'll eventually benefit us as well. So I just have a huge problem with this whole thing. And I think nothing good comes of this. And I think, getting to your point initially, is this a time that could be similar to previous walls that we hit? And I think absolutely, because the tariffs were just a pile-on to what was a growing, fragile situation.
That's some great stuff. Okay, let's talk a little bit about what market got so wrong in late 2024, early 2025, because I was shocked at how bullish everybody was. And it sounds very much like you were already on the bear case there, and you had highlighted the concentration risk and the fact that there was all this problems with AI spend and things like that. You talk to a lot of Wall Streeter folks, what the street's out there. What did they get wrong? Where were they so blinded, and what made it so obvious to you that this wouldn't be the case?
So when Trump won, everyone pulled out their 2016 Trump winning playbook, and they saw at least what the market did in 2017, which basically went straight up in a very persistent way to the point where the VIX traded below 10. But that was all because we were all pricing in the cut in the corporate income tax rate from 35 to 21.
Right.
I kept telling people, I'm like, okay, hopefully this can be a good thing, because we were, in my belief, going down this awful socialist path with Biden, and God knows where we'd have gone with Kamala, not to get political on your podcast.
That's okay. It's your opinion. You say whatever you like.
But I said, in 2016, Trump had a lot of low-hanging fruit to pull on the tax side. Going from 35 to 21, to me, was great, because it's things like that you do to reinvigorate U.S. manufacturing and U.S. business. You create a more competitive field for us to play on to make stuff that the rest of the world can buy. So I wish he would have taken that from 21 to 15 in this term, but instead got obsessed with a trade deficit and everyone's ripping us off thing. And then on the income tax, so I said to people, at best, it's probably going to stay at 21. So we're not getting that incremental tax benefit. We're at best seeing the same rate. On the individual side, we know that his tax bill expires this year. And I thought, okay, at best, we have the same tax rates. So we're not getting that incremental juice on the tax side. At best, we're staying the same. So yeah, okay, we may be happy that he won relative to her, but this is much different than 2016. 2016, rates were near zero. The S&P 500 was trading at 16 or 17 times earnings.
Right.
Now we know we have rates that are much higher. Multiples are much higher. The market's much more concentrated. This was a completely different thing. And the last tell was, well, when the Davos crowd is thinking one thing, you just bet on the other.
One of the things that you've mentioned is the fact that fiscal deficits are like, the government's deficit is the private sector's credit, which is you've rightfully pointed out. I guess one of my questions to you is, how much do you think that the administration, or at least Scott Bessent, has accepted that we have to get the deficit down and there is going to be pain in the economy or pain in the stock market because of that?
Well, it was Scott Bessent himself who used the word detox in an interview. I think it was with CNBC, and acknowledged that we've been relying too much on government spending for our growth, and we need to transition that to the private sector. I applaud him for that thinking. And he also acknowledged when use the word detox. Detox is not this happy thing to go through. It is a difficult thing to go through,
Right.
on the hopes that you get through it and things are much better. So I think he acknowledged it. But I think Trump's cult of personality and has sucked in him and those around him, and Navarro aligning with Trump on this, and also Lutnick, that somehow, again, a false premise that we're getting ripped off and trade deficits are bad, that it's making things worse, and it's going to compound that detox. It's not going to ease the detox.
Right.
Trump could have had this very easy 4 years. Do whatever he wanted with the borders, end the wars overseas, extend his tax cuts, focus on deregulation, maybe, as I said, cutting the corporate income tax rate, using that as the lever to make us more competitive. And instead, this tariff obsession is going to sink the global economy. And it is quite extraordinary that he's done this.
You mentioned deregulation, and I think that was one of the kind of Bull's pillars when he got elected, was that he's going to come, he's going to deregulate, the banks are going to be able to lend again, and we're going to get this great private sector credit boom, and there's going to be less government spending, but it'll be offset by more private sector credit creation. One of the worries that I guess some of the new bears have is that with all this uncertainty, that the private sector credit creation is going to, dry up. In essence, nobody's going to want to do CapEx. Consumers won't want to buy a house because they're uncertain. Do you buy that, or do you think that if we somehow manage to settle down policy, that with some deregulation, we could get the private sector expanding and borrowing and creating again?
Well, the borrowing and lending has been taking place on the non-financial depository side. Private credit has basically stolen. Well, for some, it has taken their loan business away. For others, banks are actually financing the private credit. So there is some of that mix and match. There is some market share loss, but there is some being in bed together in terms of financing. So private credit has taken that mantle. I think the damage being done to our trading partners and potentially global trade, but also, taking your eye off the ball here in terms of growth here. I think this is really damaging for a period of time that is not easily correctable. Can we wake up on Monday and he magically came up with 75 trading deals and he's lowered the temperature on China? Maybe, but does that end the cloudiness in terms of visibility? Maybe only slightly, because unfortunately there's just too much damage being done here. And I need to talk about China for a second, because
Sure.
We still import about $450 billion worth of stuff there that you can't just flick a switch and have that stuff made somewhere else. I mean, I'm talking to a bunch of businesses and they are in dire straits over this situation. One company, consumer products, brand private, they do about 30 million of EBITDA, and nice, healthy business, great franchise, but they source a lot of stuff from China and other parts of Asia. Their tariff bill is going to be $40 million.
Wow.
It's going to wipe out their entire EBITDA. Now, if you're running the business, what the F do you do right now?
Yeah.
Hope that Trump wakes up and comes up with a great deal? You can't even move enough time and factory production to somewhere else. Because keep in mind, when there's a particular Chinese factory that's set up to make your stuff, they have molding, they have things, they have that create your product, that you can't just shift it to somebody else like that. You just can't. So the damage that every day is taking, that this deal, that no deal takes place, you are going to be killing many U.S. businesses. And yeah, can Walmart adjust to this? Yeah, for sure. But that small business, that medium-sized business, they just can't. And you know what? China is not a manufacturing powerhouse just because, and it's not just because they subsidize. I mean, Russian communism didn't become this great powerhouse because the government was subsidizing their economy. You have to have a skill set. You have
Yeah.
to have an infrastructure. You have to have capabilities to become a manufacturing powerhouse. And people that are blaming, the unfair advantage of government subsidies or below market loans from the state sector owned banks. Well, it's got to be a little bit more than that. I mean, God, Venezuela's economy is just extraordinary with the subsidies that they get. I mean, it's just unbelievable. And I beg people who talk about China, if they've never been, to go, because it is not the most advanced manufacturing place in the world for again, government subsidy reasons. So it's again, the authoritarian.
You're fired up. You're fired up. I like it.
What they did to Hong Kong was tragic. I can't defend any of that. But at the ground level, there are a lot of hardworking people there that are trying to make a living like the rest of us. I was in Vietnam in December, not for business, but on a family vacation. And yes, it's communist, but in name only. There's no opposition rule, so there's one government. But you know what? On the ground level, economically, it was as free market as you can get. Everyone trying to boogie and make a living and working hard 7 days a week. And then we put a 46% tariff on them. They buy $13 billion from us, and we import more than $100 billion from them. Is that tragic? Well, their per capita income is $4,000. Some of these people make $10 a day. What are they going to buy from us?
Yeah, no, you're absolutely right. I saw this thing about Tim Cook talking about, you mentioned that Apple's become a industrial powerhouse. I saw this thing where he went through and talked about the skill set that the Chinese have in terms of making their phones. And he said, we just can't do this at home. We don't have the industrial engineers we need.
It's 100% right. We're not making sneakers here. We're not making phones here. And not only that, half of the imports that come into the United States are intermediate term goods. So Peter Navarro basically revealed what they want at the end of the day. I think it was last week, or maybe it was early this week on CNBC. He said, we want to make the tires here. We want to make the transmission here. We want to make the engines here. This was in light of the spat he had with Musk, where he accused Musk of just being, and Tesla being, an assembler of a car rather than the true maker of it. And he's like, we want to manufacture everything here. We don't want to just assemble it. And I'm thinking, I'm like this guy has no idea what he's talking about, because let's just say that happened.
Yeah.
How in the world is the U.S. manufacturing base going to be competitive to be able to sell stuff outside of the U.S.? Under his world, U.S. the production will just be meant for U.S. consumption. But if the price of that product is too high, there won't be any U.S. consumption. And what that U.S. manufacturer will end up doing in order to sell stuff in Europe, for example, is they'll never be able to compete by exporting to Europe. They're just going to, they'll cut jobs in the U.S. and they'll build a factory in Europe for their European consumers. Or they'll just build a factory in Asia at a much more competitive level and then use that as a base to export to other markets. So there's no real full connecting of the dots here. And I go back to the example of how the F is Boeing going to compete against Airbus in terms of global market share. If Boeing had to not only make every plane here, but make every part and every raw material that goes into that plane, how are they going to compete with Airbus for global orders? I don't know.
Wow. You are fired up. Okay. So, I listen, I completely agree. I got no argument.
Up, Kevin, because I think that this is just kicking the ball in your own net. This is such a fumble of the football. But everyone says to me, yeah, but we had to do something. We've been losing manufacturing jobs for all these years. We had to do something. And I say, I get it. I feel for these people. But you know what? That's what production technology efficiency does. Planting seeds on an acre of farmland is not done by people anymore. It's done by a machine with nobody in it. But we're not going back to the old days. We're not going back to having people planting with their hands.
So if this, okay, so let's take this one step at a time. First of all, you mentioned that even if he goes back or he pulls back or he makes a whole bunch of deals, that the damage is being done. Let's just start with, do you think that he's gonna rush to make a whole bunch of deals, like because he realizes the problems he's gotten in, or is he just gonna double down and stay tough?
I think right now that there has been so much damage done, both reputationally, financially, economically. When I say financially, I mean, you cost the US stock market trillions of dollars in market cap, not just in the US, but globally. A lot of damage has been done that they have no choice but to make these deals, whatever
Okay.
they may look like, whether it's cosmetic or, I mean, they'll end up being cosmetic because you can't make all these deals in a well thought out process. I mean, trade deals usually sometimes take years to do. You're not going to do them in 90 days in a well thought out, detailed way. They're all going to be cosmetic letters of intent, essentially. You promise to do this, I promise to do that, and we'll sing kumbaya. But now, is the market going to rally on some deals? Yes, and hopefully in the next couple of weeks. Oh, we came to this great deal with Japan, but this China situation needs to be settled. You cannot have the two biggest economies going at it like this. And you think you're going to disconnect from the Chinese economy? That is a pipe dream. If you think that we'll all be better off from that.
Okay, so you are focused on the Chinese situation because you think that that's where the real, as you said, the two biggest economies, and that's where the real conflict is. What if China doesn't blink? What does this look like? And what if they just continue down this path and they just say, no, we're not going to blink? And what does happen to the US economy? Like you mentioned, these companies going bankrupt. I heard someone tell me the other story. You said that Walmart can handle it. I heard a story the other day of somebody that was selling to Walmart and they're, saying we can't keep selling to you at this price. And Walmart said, to pound sand, you owe us. And like they're going to be going out of business because they can't afford to continue supplying to Walmart. Walk me through the situation if China doesn't blink and this just continues as a stalemate.
Well, that gets to my point that every day there's a business that's potentially going to go out of business because they can't afford to sell to Walmart anymore. And before I answer that, I'll get to another example. I mentioned my trade deficit with Nicole. Well, Walmart has a trade deficit with China. Is China ripping Walmart off? Well, Walmart, not by accident, is the largest private sector employer in the United States. Maybe Amazon's a little bigger, but I think Walmart's at 1.6 million employees. They have benefited tremendously from their trade deficit with China. China has benefited tremendously with their trade surplus with China. Us as consumers have benefited tremendously from their trade deficit with China.
Got it. So what happens? Sorry, keep going.
No, go ahead.
I was going to say, so what happens if this stalemate just continues?
Yes.
Does the economy just roll over and sink? And is that the nightmare scenario?
It's what art of war meets art of the deal. And art of war is, I think, going to win because Xi just told Trump, go F yourself. We're not backing down like we did in 2018. And what did Trump say in the Oval Office yesterday? I think we're going to come to a deal with China. What did he say today? I think we're going to come to a deal with China. So I think that, and so he's going to make it seem like Xi is not kissing his ring.
Right.
So hopefully they both sort of extend their handshake at the same time, not one before the other. Hopefully it's the same thing. But Xi is not stepping forward 1 inch before Trump does. But Trump's already got some shaky knees based on these two comments, which I'm hopeful that this gets him to say, okay, enough is enough. Let's come to a deal. He said that the last 2 days. I hope he does. But what's the complexion of it? At the end of the day, we're still going to have 10% tariffs on the whole world. Why? I don't know. We're still going to have the steel and aluminum tariffs, which obviously no lessons were learned from 2018. Auto tariffs, God knows what is going to be of that. We're going to disrupt, decades of smooth, efficient auto supply chains. So we're still in a ton of mud, I think, here, a quicksand with tariffs, even if we make these glorious, deals with all these other countries. I think at the end of the day, he should have came in and said, my goal, my one and only goal is to knock down trade barriers that are unfair to us and even the tariff rates amongst countries. If he would have done that, the whole world would have been better off because in the aggregate, there could have been freer trade. But that clearly was not his real goal.
Okay, so if we have a situation where we get a deal, but as you rightfully point out, even a deal will probably still have tariffs, right? And it'll still be inflationary. It'll still cause all sorts of problems. Do you see a situation where, U.S. stocks go to the same, multiple as the rest of the world? Like, is that what you're, what you kind of foresee? Like you mentioned that we were 22, we're 18 now, although I think maybe today we're 19. Are we headed to 14 like the rest of the world?
I know, maybe I'm old school, Kevin, but I remember that for many, many years, many, many decades, what was the average P multiple in the S&P? 15 times, right?
Yep.
And then
And
we enter this world of zero rates, negative rates, QE, and all of a sudden, 18 times, 19, 20 just became this new normal. And why can't we go back to 15 as what we used to? Because we're not going back to zero. And if the Fed does QE, it's because the bond market's blowing up in their face. So we just don't have the macro background landscape to sustain high multiples anymore. It's just a question of what is that E going to be at the end of the day? And you can be sure it's going to be below where estimates are right now at 270-ish for 2025. And where is that PE going to go? One of the things that I can't stand about these price targets, and I used to be part of that crowd, is you had to pick out of thin air what the PE multiple was going to be.
Right.
The E was much easier to predict than the PE. And so I was more focused on, okay, what's the trajectory of the PE going to be? And I can argue that the trajectory is down, not up.
Yeah, I get it. And by the way, you mentioned you were old. You remember when PEs were 15. I also remember when you used to pay more for emerging markets because they were be able to grow more.
That's right.
Yeah, and it was a different environment. Okay, so let's talk about, you mentioned bonds a little bit there. Bonds are having their moment in terms of being a little bit spicy in terms of their moving around. I was like looking at the 10-year went down to 390 earlier in the week and it's trading at 450, 460. It's all over the map. What do you think's going on there? Are you worried about it? Is this the kind of the canary in the coal mine that you should be watching?
All right. So just some background on my thoughts. In 2022, when we had 9% inflation in the US and obviously high rates around the world, even though it's not apples to apples on how each country measures their inflation stats. To me, that was the end of this glorious 40-year bond bull market and I'm going to get hyperbolic for a second. When we had $17 trillion of negative yielding bonds, it was the biggest financial bubble in the history of bubbles in terms of dollars. There was never a bubble that size. And we are experiencing the continued unwind of that bubble, where sovereign bonds just don't hold the same place as they once did. That inflation is not magically going back to this 1% to 2% level on a sustainable basis. Sustainable being the key word here. Japanese bond yields are not zero anymore. The JGB market is not this global suppressant on rates. I mentioned before that maybe the Fed does QE, but that's for emergency purposes, just like the Bank of England did a couple of years ago with the LDI mess. So QE is just not a lever that can be pulled here anymore to help the global bond market. So I think that, and I'm talking about the long end. The short end obviously is more tied to central bank policy, and that can be sort of more manipulated than the long end. And then, of course, the major thing here that we've reached the point of is, and I actually think this started with the selling in the Mag 7, and I want people to understand that the Mag 7 trade was not just a love affair with US institutional and retail investors, it was a love affair with the whole world. And if you look at the holdings of foreign investment managers, a lot of their holdings were in Mag 7. If you look at the holdings, the top holdings of the Swiss National Bank, they own the Mag 7. The Norges Bank has an investment arm. They're all long the Mag 7. As of December 31st, they were the 10th largest, they being the Norges Bank, they were the 10th largest shareholder of NVIDIA. Yeah. They owned 324 million shares of NVIDIA. So this trade became in itself a global reserve asset, just as treasuries were, just as gold was or is, just as the euro is. So you can actually chart the dollar index, the Dixie, which is certainly yen, euro heavily weighted, but overlay that with the Mag 7, and they pretty much follow each other over the past year. So the love affair with U.S. assets started to die off with the DeepSeek news. And now that the U.S. has pissed off the rest of the world, that is now getting exaggerated because the U.S. markets are now behaving like a third world country where interest rates go up, but your currency goes down. Yeah. And we know, Kevin, that this typically happens in emerging markets. And so the US market, where you had stocks going down, dollar going down, bonds going down all at once, was what was most scary about the week, was seeing that behavior because it's not something we ever really saw before in the US.
Yeah. I completely agree. That was probably the story that didn't get enough attention that it deserved. That fact that you had all three going down at the same time. It means capital is leaving the US.
And it actually it exaggerates the tariff problem because within the White House and the PhDs there, well, we can mitigate a tariff placed on another country because the US dollar is going to strengthen against that currency. Yeah, well, in your school class, that sounds all nice and good at Princeton, but in the real world, it doesn't always work out that way. So we're now compounded. So the U.S. importer, the U.S. consumer is now full on paying these tariffs. It's not going to be absorbed by the exporter to any great extent. That's going to make us feel good.
Right. So you have this situation where stocks are going down, bonds are going down, the U.S. dollar is going down. What do you think investors should be thinking about doing to protect themselves in that environment? Because that is like a trifecta of terribleness.
So when Mag 7 started to sell off, international markets started to trade very well. And it wasn't just a rotational thing. I mean, there were some fundamental factors, whether it was Europe committing to Keynes style, fiscal spending, obviously on defense, but in Germany also a lot of money that's going to go to infrastructure over the next couple of years. And that is, from what I hear from people that have seen it, it's been deteriorating over many years. But also there's been a realization in Europe, whether it's Draghi, Lagarde, van der Leyen, the EU commissioner, that they've suffocated their economy through excessive red tape, bureaucracy, regulations. And actually, interestingly enough, what Musk has done with Doge in the US has woken up the Europeans that, maybe we've gone too far with our government activism. And how the US is behaving with trade, it's resulting in Europe having no choice to get their shit together. And in fact, the Spanish prime minister this week is in China meeting with Xi, potentially doing trade deals with them. So there's, I think, a legitimate reason for Europe finally getting off the mat here in terms of their markets. And even today, even with all the stuff we've thrown at China, the Hang Seng Index has outperformed the S&P since the beginning of 2024 because that market got dirt cheap. And the AI tech trade in the US that died here was shifted to China. And yes, their markets have pulled back over the past week, but the tech news there gave them some hope. Xi meeting with entrepreneurs there gave the China trade some hope. So I think we're in a multi-year phase of U.S. Stock market leadership being transferred to international market leadership, emerging market leadership, both on the bond side and the stock side. And that's how we're positioned.
Do you find that when you tell people that, or when you try to convince folks of that the pushback is quite huge? Or do you think they're finally getting the message now that we've had 20% outperformance on European versus US stocks?
Well, the first reaction to me is, nothing can beat the US. We have the greatest companies. We have the greatest economy. And I'm like, well, I don't disagree. I'm an American. I think everything we do is done at a high level. But that doesn't mean that our stocks have to continue to go up in a straight line. I mean, the US market over the last 100 years had periods of bull markets and bear markets and long periods of consolidation. And just maybe we're in a long period of consolidation upon us, where the returns are not going to be made here. They're going to be made elsewhere. I'm also very bullish on commodities. I've been very bullish on precious metals for years, and I still think that there's upside, particularly in the miners. But I mean, oil at $60, they're just like giving it away. And I understand the demand concerns and a global recession brought on by these tariffs and other reasons. But to me, it's $60 to steal. And ag, I mean, corn and soybean prices traded well this week, and even though they're still very depressed, and uranium. And so we're very bullish on there. So Canada, a natural resource country, can well outperform the S&P. Australia can well outperform the S&P. Brazil, where's China going to be buying more of their soybeans? They're going to be buying more from Brazil. They're going to be buying more oil from Petrobras because they don't feel like buying from us. So we recently initiated a long position in Brazil last month. So I just think that investors tend to think that what has worked will forever work.
Right.
And you know what? And for many years, that's a great run. And playing that game has works for a while. But you have to understand when it's time to get off the bus.
Right.
And you got to catch another bus that goes in another direction. Because if you continue on the same bus, you're going to end up in the wrong neighborhood. And I think this is the time where it's time to take another bus.
I love it. That's a great line. That's awesome. All right. You mentioned commodities. I'd love to hear your story about why you're bullish commodities, because I think that if you spoke to a lot of folks, they go, listen, we're going into a global recession. Why would you want to own commodities? And I would love to hear your reasons.
All right. Well, let's separate them out. Obviously, gold is trading as well as it has. And, it's been in a bull market outside of a mini bear in 2015 since 2000. I mean, gold's outperforming the S&P over the last 25 years. Now, of course, you can pick and choose your timeframes because it underperformed for 20 years prior. But, it's been in a bull market. And, it got its second leg when we being the US and EU froze half of Russia's central bank reserves. Now it's getting another leg because of investors fleeing US assets, foreigners, I should say, particularly, and buying gold. And gold is the most important reserve asset right now. It's no longer treasuries. It's no longer the dollar, even though the dollar will still remain a reserve currency of the world. But that doesn't mean its status needs to be at the same level. It doesn't mean that central bank allocations to it needs to be at the same level. It was 62% not too long ago. Now it's 58. Can it go to 55? Yeah, it can still be above 50, but it could be shrinking. So that's gold. Silver is some days silver trades like copper because half the demand for silver is industrial, but more often than not, it trades like gold. And now it's trading more like gold. It's finally getting some juice to it, but it's still well below its highs. I mean, $30 silver, it was $50 in 2011 on that parabolic move. It was $50 in 1980.
Yeah.
45 years ago. So to me, there's a lot of upside in silver. You can buy silver now at, I think, at Costco, just as you can buy a gold bar. And you know what else you can buy at Costco? You can buy a a platinum bar too. We're long platinum. People thought that there would be no need for catalytic converters. Everyone was going to go EV, but hybrids are winning the Betamax VHS war, it seems. And that a hybrid still needs a catalytic converter. And for some hybrids, you need actually more platinum and palladium than you do with an internal combustion engine. Now, I'm more focused on platinum because 40% of it goes into catalytic converters. I want to have more diversified use of it, whereas about 80% of palladium goes into that. I want to have
Okay.
less of that because you're still subject to, the cyclicality of the auto business. In terms of ag,
Actually, before you do that, can we just talk a little bit more about platinum and palladium? Are they also, my understanding, below the cost of production in essence? We have a situation very much like uranium when it was, you knew you were buying an asset that was at least close or below the cost of production. Eventually, it's going to have to go higher.
yeah, so it's below. If you go to the World, I think it's the World Platinum Association website, or the World Platinum Council, Associate Council. Okay, I'm spacing on this, but they are talking about the deficit, the supply demand deficit in platinum right now that it has been for the last couple of years, and they estimate it to be for this year and next year. And the three biggest producers of platinum in the world?
Nope.
Russia, South Africa, and Zimbabwe. Those are your three major producers of platinum. So, and it's 50% below its peak of 2011. So, we like that. I feel like on a risk reward basis, there's more upside than downside.
Okay.
On the ag space, I've been following ag for a long time. I used to own farms in Iowa, not because I was a farmer, but at the time I thought it was a good asset class. But what it did was force me to learn about ag.
Right.
And just like any commodity, you buy when the cycle's down, you sell when the cycle's up. And we had owned some of the fertilizer names like Mosaic and Nutrien going into the Russian invasion of Ukraine, and crop prices spiked, fertilizer prices spiked. Obviously, had no idea about whether that invasion was going to happen, and we didn't own it for that reason, but sold on that spike. So Nutrien traded above 100, Mosaic traded above 60. Everyone thought that Ukrainian supplies would get disrupted, and same with Russia, Ukraine being with the breadbasket of the world, they nickname it. But then people realized that there was really no disruptions to any great extent. Crop prices fell dramatically. Corn went below 4, soybeans went below 10. Fertilizer prices are highly correlated to that, even though fertilizer goes into other crops as well. So Mosaic, Nutrien, to use them both as examples, got destroyed. Mosaic traded below 30, Nutrien below 50. And I said, and then at the same time, when I started looking at them again, when I looked at the CFTC data in terms of positioning, last year in corn and soybeans, there were net record shorts. So I'm like, all right, net record shorts for non-commercial traders, usually a good contrarian indicator for price. Fertilizer stocks have gotten destroyed. And after getting destroyed, Nutrien's dividend yield at 4.5%, Mosaic at 3+, both generating earnings and cash flow sort of at the bottom of a cycle. That's when we got long again. So here we are now. And I think that the shifting trade flows now are actually going to be good again for commodity prices. And I think just broadly, in particularly ag too. So that, and also you can get into more detail about stocks and use and inventory levels and so on, that I think is favorable right now for crop prices. Now ag is different than other commodities because you have, any deficit or surplus in a particular crop can be cured the next year because, you have a planting season every year in the US. Argentina, Brazil with the seasons, you can have more, you can have 2 instead of 1, but you can quickly adjust a deficit or surplus, where if you had a deficit in copper or other metals, because it's not easy to bring something on, you can have years of deficits, you can have years of surpluses.
Right.
Now on the oil side, that's really been the tougher one here with oil down to $60. We started buying oil stocks in October 2020, taking a flyer thinking that the vaccines would have some effectiveness, and that trade has worked out well. But even now, the big oil companies, we own most of the ones outside the US because they traded at a much lower multiple than US ones, like BP, Shell. We actually own Canadian Natural Resources.
Yeah, great company. Yeah.
A phenomenally run oil company. That these companies can make money at even $60 oil. They can pay a nice dividend. And, I look at US shale, we know was a big needle mover in terms of global production, in terms of non-OPEC production, and numbers went up like this for years. Well, US oil production is flattening out because outside of the Permian, all the other shale basins are rolling over. So there this idea that U.S. production is just going to continue higher. It's not until some other thing is discovered here. And there's signs that the Permian is even flattening out. So I think at $60 oil, even with the demand worries, the rig count today in the U.S. fell by 9 rigs. I mean, there's going to be drilling that's shut in, not just in the U.S., but elsewhere. And I know OPEC just raised production, but that can be reversed at any moment. So I think down here, oil is very cheap. And then uranium, you mentioned, we've been long uranium for a while. Obviously, the stocks have pulled back. Spot uranium, which doesn't necessarily correlate to contracted uranium, that's fallen. So a lot of short-term traders have gotten out of the stocks because of the spot price, even though contract prices are hanging in. I still think there's a wide supply-demand imbalance that's going to take years to address. And even in this environment, it'll make it even worse.
Okay. All right. Let's finish up here with something that I like to ask guests. And I said, what question would you ask yourself that I missed? Like, what is the kind of biggest story that I've glossed over, or something that's on your mind? Like, what would you ask yourself?
Peter, why are you always downbeat and scared? With it all the time, like, I'm just trying to call balls and strikes here, and I manage other people's money, and we do as a firm, and we want things to go up. I just think that sometimes they don't, and you have to be well positioned for it. But I like to buy things when they're down, and things are down. So there are a lot of attractive opportunities, even in the US. There are a lot of cheap stocks out there that we own and I love, that I'm going to buy more the cheaper they get. So embrace down markets. Don't criticize me for it, because you'd rather be buying things when they're down rather than chasing them because they're going up, and being bullish because everyone else is bullish. Be bullish when people are bearish and vice versa.
All right, I got it. That's awesome. Now we'll leave it with a question that we'll talk about concerts. And one of the questions I like to ask some guests is, what if you could go back in time and listen to any concert? Which band would it be, where, and when?
Does Woodstock qualify?
Yeah, you can do what nobody's ever done. Woodstock, actually, that's a good one. So
how incredible an experience that would have been.
Although it was kind of raining and stuff. I don't know. Do you think it was one of those cases that it might have been better, like when you thought back on it, than actually being there?
My 20-year-old self, it would have been great. My current age, I'd watch it on TV.
What would have been your favorite? Like who playing would have been like your favorite? Like, I don't want to miss this one.
At Woodstock or
yeah,
elsewhere?
At Woodstock.
I mean, just to see Jimi Hendrix.
Yeah, that would have been.
To see the Grateful Dead there, to see that classic Joe Cocker performance would have been unbelievable. To see the Who there, to see all this all in one place with, a couple 100,000 people. It would have been muddy and dirty, and I wouldn't have showered for days or slept. But looking back, it would have been pretty cool to think about.
That's awesome. That's a great choice. All right, Peter, before we let you go, could you tell people about yourself in terms of where they can contact you? Which kind of people should contact you? Like, if you're retail, please reach out here. If you're institutional, please reach out here. Give people the whole spiel.
Well, if people care what I think and what I write, they can go to Substack and read my newsletter. On the wealth management side, they can go to bleakley.com and learn more about our firm and reach out if they're interested.
All right. And once again, the newsletter is the Book Report. And it's like
BOOCK.
CK. That's right. The Book Report. Peter, it's always a pleasure having you. I like this, Peter. He was fired up and he had lots of views, and they were spicy takes. I love it. Thank you very much for coming. Yeah, sure.
One of the stocks we own is Kenvue.
Yeah.
And they make Tylenol. And I think what we've seen over the last 2 weeks in these markets and the economy, I think a lot of people reached for their Tylenol this because we all have headaches after what we've just experienced.
Oh, isn't it unbelievable? I was chatting with some guys on the desk about this and saying how it's like literally, when was Liberation Day? It was a week and a half ago? Yeah.
April
so we're a week and a half, or not even, basically a week and a half. And it feels like this has been 2 months, doesn't it?
2 years.
Well, thank you very much for making time for us, Peter. It's a real pleasure having you on again.
Thanks, Kevin. It was a pleasure.
Take care. All right, Patrick. Although, geez, I'm sitting there staring at the ocean. All I can think about is, God, I'd love to be there. What do you got for talking charts, bud?
All right. Well, let's actually go through the top 3 things we were watching last week. And boy, listen, I can't. This has been the longest 2-week gap that we've ever had between a 2-week show. Like when Julian was on, we were talking about everything from the big JP Morgan caller that was rolling off the jobs numbers, and we talked about the tariffs. And we were like, there's going to be Liberation Day. No, like we did debate. Like you did say that people are underpricing. You did highlight that it could be more volatile or not. You actually made me take it from number 2 to number 1 in terms of the top things to watch. So like you clearly had your radar, but I think can you agree with me
that it was even more than I thought? For sure. 100%. I thought it would be bad. I was sure the market was underappreciating it. But if you had asked me to like pick the numbers and pick how crazy it would have been, I would have been less than that.
Yeah, and a shameless plug for myself, because we did promote on that show the hedging webinar that I did. And those listeners that jumped on and did some hedging, I think it's been a grateful 2 weeks of hedging.
That's right.
It was definitely the right time to be hedged up. So anyway, that's enough about that. Let's talk about the top 3 things to watch, and then we got to go and reflect on the last 2 weeks. But let's just start with this. One thing that has become obviously dominant is the Sell America trade.
Right.
And
let's explain to people what we mean by that. It's the selling of the US dollar, stocks, and bonds altogether. People, capital leaving the America. And it's very unusual for this to happen. Usually you'll get bonds going up, stocks going down, dollar going up, stocks going down. Very, very unusual to see this.
And you know what? But what's interesting about it, it was not just that Trump triggered it with the tariffs, but you have been for months, a year, talking about how the amount of investment into the U.S., into the Mag 7s, into all of this was just so extraordinary. The weighting of global market capitalization into the U.S. was at historical peaks. And it just needed a match to light the bonfire. And Trump was the match. Like it was an unstable situation. In terms of it was already way too far. And now we are seeing that capital redistributing. And, everyone tries to make it quite extreme. But I like the way you put it even before this whole shit show started, which is it's just about rebalancing the weighting of shit in your portfolio to be more distributed everywhere else. Like everyone's so concentrated just by saying, I'm no longer going to be concentrated in the Mag 7s. I'm going to have Mag 7s. It's just not going to be such a huge weighting in the portfolio. I got to buy other stuff.
Right.
And so we're seeing a rebalancing in many ways, but it feels pretty dramatic when it's all happening at once.
Right. And listen, this is a line that Cuppy shared with me. And he always, when we were discussing it and I'd give him my theory, he'd always be like, okay, can we have the rebalance without a global margin call? And there was moments that we can get those rebalances. Like on the initial day after the tariffs, if you actually looked at the rest of the world, it was actually up. Even the Australian dollar was up. And then it was when China came in, cranked the tariffs the other way, that all of a sudden everyone thought, realized that this was going to become a trade war, became much more serious. And then we get this cascading margin calls. You get all sorts of weird things happening. You saw moves that we theoretically should never see. There was a piece that I saw from, I can't remember, it was one of the sell side banks. And it was like, this is a once in 29,000 year event. The different moves. And the reality is that whenever you start to hear those things, it just shows you how ridiculous it is to use normal distribution in terms of assuming that these are what's going to happen, because we know that that's not how financial markets are distributed. And we're in one of those periods. And so we're struggling between that rotation and the global margin call. And that's, I think, what you should, how you should think about the price action. Are we in a point where everything goes down, or could the US go down and some other things go up?
Well, I want to talk about these charts in a moment. So let's go on to number two. Number two, we have central banks. Actually, the one thing that was number four, by the way, was we have obviously retail sales and the flash services and manufacturing PMIs. It's going to be really important to see whether all this turmoil is spilling into kind of the consumer confidence and spending, and whether or not it signals recessions. But we didn't make our top three, but I think it is important to watch. But number two is central banks. And we have Bank of Canada and the ECB and even Powell speaking all next week. And so we're going to see how central banks are reacting to this. Clearly, the Fed minutes still had the Fed far more focused on inflation risks and not being in a rush to adjust things. I'm surprised that there wasn't even a little bit more of a dovishness to it than there was, even if it was just in the language. Were you a little bit surprised or not, or was this exactly what you expected?
I'm not surprised in terms of how the economy is unfolding. I am a little surprised that they weren't more worried about the bond market. And I've always said that the bond market is actually what the Fed watches, much more so than the stock market. Folks often assume that the Fed panics when the stock market goes, down a long way. But the truth of the matter is that usually credit spreads are blowing out or something else is happening in the bond market, and that's what they're watching. You just go back to the December of 2018 when Powell did his long way from neutral. The credit markets just seized up. And once they seized up, the stock market was going down, but it was really the credit markets that made them really scared about the economy not being able to roll over debt. And so for the first time, we're actually starting to see some real dislocations in the US Treasury market. So I expected that Fed would be watching that and potentially could be thinking about intervening for that. What was most interesting, though, Patrick, is that it wasn't the Fed that panicked from the bond market. It was Trump. If you go back and you look at what he said some people were getting queasy about the bond market, blah, blah, blah. That's why we're going to put this hold on it. I think Scott Bessent said, listen, this is a shit show. The ups and downs, all the different people talking is causing investors to lose faith. We need to do this. You need to give me, and rumors were, the mooch at least said that Scott said, I'm leaving unless you put me in charge of this and let me actually do something that's going to keep this thing under control. And so I think that that's what happened. They put it under 90 days. Scott Bessent got a lot more involved. They sidelined Navarro and Nutlix. And the reality is that we now have a situation where they're trying to stabilize the bond market. So I never expected the Trump to panic from the bond market. I expected the Fed to, but it looks like that's what did happen.
You really transitioned into number one. So let me quickly just show it on screen. Number one was, does the market force Trump to blink? Which you basically already have this. We're having this conversation as we speak. I want to circle back to the central banks, and then we'll talk more about Trump blinking. But the interesting part was, it really did become a global margin call. Like the Euro Stock 50 was one of the strongest stock markets. It was ripping to the upside. And then it wipes out like peak to trough 20% in one fluid motion, while the S&P took a month or more, 45 days to do the same damage. And so it became like a broad liquidation where Europe and the Nikkei and all of these other markets started to spill. The thing is that while the Fed has already kind of expressed their concerns about short-term inflation risks and other stuff, the thing is, what is not clear is how other global central banks are going to be reacting to this. And is there something that you feel that you're looking from the Bank of Canada and from the ECB that's different?
You know me, Patrick. I'm already believe that fiscal is more important than monetary. And I think that right now the central banks don't matter as much as folks might perceive. There's only so much you can do when the reality is that you're getting tariffs, being put on at 25, 50% at a clip. And there's yes, eventually they're going to panic. Yes, eventually they're going to lower rates. But until we see the hard data roll over, I don't think you're going to get that clarity from any central bank.
Yeah.
So the reality is that we're in a wait and see mode for, the economy to roll over. And then I guess the real question is, how quickly do they do it in the face of potentially inflationary tariffs? But we're not there yet.
Right. All right. So let's talk some charts, and let's put this. Let's actually pull out the crayons and have a look at this. So first of all, let's just start with the S&P and just talk about this extraordinary decline. Now, in the end, from there was that one piece showing the biggest down days in the last 35 years and the biggest up days. Like this was like not even in the top 10 biggest down days. So while we do feel a lot of pain on the downside, it wasn't extraordinarily, it wasn't in 1987.
Nope.
It was definitely selling. But what's interesting is that the total decline was about 22%. And you know what I found really interesting about that? 22% in 45 days. It is very reminiscent of the first drop that happened in January 2008. Now, I don't want to imply there's a financial crisis. I'm just making the analog of the fact that in January 2008, we had a 22% decline that took just under 2 months.
Okay.
It was the first shot on the downside of the market, and which marked the low that lasted all the way until May 2008. Now, whether this turns into a recession, whether this turns into a bear market, is something me and you are going to be debating for, I think, many episodes still in the future month or two. Like that, this is not going to be clear in 2 weeks.
100%. You're bang on
right?
correct there.
Like this is something that we're going to be persistently talking about for 2-3 months as we move forward. But what's interesting here is that, at least from using that as an analog of the first drop, in my opinion, there's a very good odds. No, it's not very good. I actually will make the call that this swing low is in. If this turns into a bear market and there's another leg coming going into the summer, yes, we will break to lower lows. There's going to be more bear market, but for the month of April and this wave of the selling, I think it's over. And not think it's over. I'm calling it. It's over. I'm not gonna be wishy-washy about this. And then I covered a lot of not a lot. I covered all my shorts over Friday and Monday of last week into this week, and I went long this market 2 days before Wednesday. So it was a little bit of chaos going into that, but my thing was with the rally that we saw. That first of all, now that was a historic rally.
Yeah.
Like literally, what was it? 6 minutes? Was it that it moved 300 points?
Oh, which one are you talking about? You're talking about the Walter
Wednesday.
Bloomberg, or the actual? Oh no, the big one. Yeah, no, it just gapped. Like it was so fast. Not only that, that was the second largest one-day NASDAQ rally that we've ever seen.
Yeah, and since 1990, it was the third largest S&P move.
Okay.
So going back 35 years, it was the third largest. So it was actually quite historic in terms of the magnitude of the rise.
But you and I know, and we've been talking about this on the show numerous times, the biggest rallies are in bear markets.
Mm-hmm.
And they just
bear market rallies are almost always the most violent. And but the one topic I want to quickly just go on a diverge off and talk about this. With the algos and AI and all of these things now becoming more and more relevant in this trading business, is it now accelerated things when a turn point happens like this? The fact that we literally within an hour were up, like literally, we retraced exactly 50% of the entire bear market in 3 hours. In 3 hours, it took
So is your question
45 days.
is your
So the point
question
is
like
that has this created a scenario where almost like any guy with a crayon is not going to catch these moves because these algos and everything just make this instant freaking repricing on one headline, and the move is literally over before you can even get in.
well, so there was like, if you go pull up the intraday chart of that, you'll see that there was an initial move and then it grinded higher from there. So it's not like you would have missed the first 5% or something, but then the next part you could go see there.
Yeah.
Like, so that, so the
you're
first,
saying
like,
you could have caught this.
there's lots of time.
Okay,
There was time in there.
okay, when you say lots of time, this
No,
thing
no, but
literally was up 7.5% in the first impulse,
but no, but you could
and
buy.
then
There's like it dipped down to 6 or whatever. So yeah, so the first 5 was
but
immediate.
the point is, then you're talking about an extra 3% over the next 2 hours, right? So like literally, you had a scenario where 70% of the move happened, and then 30% more was tradable.
Yeah, I won't disagree with that.
Right, but like it's one of those things where you can't, as a human making a decision, be fast enough to catch that move, like to see the headline and to react to it. These machines would have beat you.
Yeah, I think there's some fast traders that got it, but you're right. You need to be sitting there staring at the machine and not be afraid to buy something up 4%. You have to be able to figure out what that means, and you have to be really
Yeah.
quick. So you're absolutely correct. It is more
You know,
difficult to do today than it would have been way back when. But way
right.
back when, you also didn't have direct access, so it was on the floor, and it
Yeah.
was you'd phone
So
up and ask for quotes on the S&P, and it would be a fast market, and you wouldn't be getting your fill back for an hour. And it's so
you
I'm
know
not
you,
so sure that, yes, the HFTs have made the game harder, but they've also, the fact that there is the ability to have HFTs mean that there's also the ability for individuals to go and to trade stuff. And for example, Patrick, you could have had automatic stops in there and you would have got filled. You would have been part of, there would have been some slippage, but I bet
yep.
if you had
I
had
hear you.
stops, up above, if anyone wants to say, oh, I had stops in there and my slippage was X, put it in the comments. I'd love to hear it.
Yeah. So the crazy part is that in the past we have seen these rallies retrace 50 to 60% of the prior declines during bear market rallies. The crazy part was my upside target when the market was down at 5,000 and I was closing out my shorts. I was thinking about going short again when we get up to the 55 to 5,700, and we fucking hit 5,500 in 3 hours. It's
Yeah.
like I'm like, do I go short already? Like, yeah, I was expecting like the bear
And you
market
could
rally to last a week or two.
you could have gone home that night short.
Yeah. Well, I still actually think that so here's my call. My call is going into Easter next week. There's one more push higher, and we get above 5,500, maybe as high as 5,700. But my confidence level of 5,700 is not as high. But I think that us going up 5% from here into next week is still very likely. And one of the things that, first of all, that I think is really interesting is we've seen the market stop reacting to tariff announcements. So when China escalated with the new tariff increase, market kind of went down a bit and recovered. Like the market is no longer emotionally responding to escalation. And two, we're seeing this bond and dollar shit show and the stock market's pretty chill. Like,
I would agree with you there. That is
right,
yes, I
right,
completely agree.
and so if we have this dollar and bond freak out, and we have these tariff retaliations, and the stock market is already found a spot, then what is going to take it down next level? I don't think there is. It would have to take a new introduction of something new that the market has not yet priced in. It would have to be some new surprise. And while anything can happen in the markets, we can never talk about certainties. But I seriously doubt in such unstable markets that that the existing administration or anything was going to say anything that's going to rattle the markets. They want everything to settle down, and so I feel pretty comfortable that the market has already banged out its bottom, and we're going to see even 5% higher in the next week, but this is still, in my opinion, a bear market rally. I am not bullish long term. I do not think that this is a buy everything that's not nailed down, because in 5 years you're going to be so happy that you bought down here. I think that kind of a call I'm going to reserve for the summer. Like, I'm going to wait. I'm going to wait to see how this plays out. But on the short term, I think we're going to go a little bit higher. And even if we do peak out next week along 56, 5,700, I don't think it leads to the next major decline for at least a month or two. If I was to say when is the next shoe to drop for another major leg down, it's probably a May, June, and even July story. I think that while I do think the risk is very high that the market still has another bear market leg down, especially if the recession risk becomes high, if jobs numbers start to show things, if earnings guidance in this earnings cycle massively gets curtailed and everyone's dialing back on their earnings expectations, there could be all sorts of things that start rattling the market going into the tail end of the second quarter. But for April, I think the market goes higher and is going to be relatively stable. That's my call. What are you thinking?
I don't disagree. I'll use a kind of I'll come to the same conclusion from a different perspective. If you go look at the S&P 500, it was trading almost at 23 times earnings at its peak when, we had the American exceptionalism. Trump is going to, bring in a world of the golden age of, deregulation and business confidence. And we've gone from 23, and at the low, we were trading at 18 times. Next, like the blended 12-month forward earnings at 18 times, that's a big correction. Like, that's a big change in terms of the valuations. And although I ultimately believe that we are headed towards parity versus the world markets, so we're going to be down 14 or something like that, the fact that we're down at 18, I think that the next move in the stocks won't be the result of the PE multiple coming in. It'll be the result of the actual earnings, earnings rolling over. So they're not going to take the PE down anymore. They're actually going to go, and we're going to see a situation where the E is going to roll over. So
I'm going to see if I can find this one Goldman chart, which I loved. And it speaks to exactly your point. This one here. Hold on, let me, how can I, let me just find a way to put this up here.
So that's in essence why I think that you could be correct that we pause here, chop around while we're trying to figure out if the E is going to roll over.
Yeah. Okay. So here's the chart. So what you can observe here is that they had the earnings per share scenarios for 2025. And they had the multiples on the y-axis, so you can see 22 multiple all the way down to 14 on the bottom end, right? And they're just showing the Goldman Sachs baseline and then the recession scenario. What's interesting about this recession scenario that they're showing here is that they're only talking about an earnings contraction of 11%. When you go back and look at previous recessions, the average earnings contraction during a recession is anywhere from 20 to even 40% sometimes. I don't think there was ever just only a 10% earnings contraction in a recession. I mean, we've had someone that was not a recession, just a period of slowness. But I mean, in the great financial crisis, it was an 80%, and I don't think anyone wants to forecast.
No, so
repeat.
first of all, I think you got to be careful here, Patrick, because you're using like realized numbers, and the market trades based upon forward numbers. So, because I was like, those numbers sound high, I was just going and looking here. So, for example, in the GFC, the rolling forward went from $177 down to $140.
Okay.
So, and I think that, yeah, there are times that you get a really bad year, and then and they throw their baby out with the bathwater and they put all the bad news into it. But the market's always looking ahead at it.
Right.
So I'm not sure in terms of their.
Okay, so I would, yeah, you're talking about, okay, I get it. That we're talking two different metric. Okay.
Right. And I think the market trades more on the forward than it does the
so
realized.
let's just say that's 11% that they have here is realistic for a recession scenario. Okay.
I think that's a little low. So I think that would be like we had almost an 11% in 2022, if I'm correct. So to me, that's kind of borderline recession, more of an earnings.
What would you say?
Earnings
15
slowdown.
to 20%?
Yeah. So I think 20 would be realistic.
Okay. So you can see with 11% at an 18 multiple is basically S&P at 3,900.
Yeah, no, listen.
Right.
Didn't we do this didn't I do this with you on this show before where we talked about BCA's Bearson's line, and he says he has his 4,700 call, which by the way, is looking more and more genius all the time. He's looking like he might have been too high. It's not hard to get to that. If the economy rolls over and we go back to a typical multiple, we're going to be at 3,700. Like, I think I did the math. So here we go. Let's just look at the forward earnings currently are 275.
Yeah.
Let's just assume we get a 10%. So let's just assume we go down to 250, just to keep rates, just to keep things even. So we go down, we're at 250, and instead of paying 23 times earnings, let's just assume we go to the middle of the range, which is a 15. Okay. So if we go to 15, we're 3,750. Yeah. It's not hard to get there.
It's not hard to get there. The point is that, and listen, this is where I will 100% agree with you. We're not in any disagreement. Here's my call. The tariffs are not going to be a catalyst for another leg down. If this is a bear market, it's a recession and an earnings contraction and multiples being taken out that is going to drive the next leg down, not the next tariff announcement from Trump.
So Patrick, I think that is really, really great analysis. The only thing I will say about that, though, is the earnings and the actual slowing down of the economy will be the result of the tariffs. So it won't be the actual announcement.
Yes. Yes. And a lot of that has to do, like my whole argument going back even a month or two ago was the lack of clarity to businesses with tariffs. Because remember when it started with Canada only, like in Canada and Mexico were kind of the thing that it didn't, this Liberation Day didn't get announced back then. It was still the drama with Canada.
Right.
But the point I was making back then was this impacts businesses in a big way, because what business is going to do a big capex spend? What business is going to go and do a big investment into growing out a big line when there's a lack of clarity how the chips are gonna, like how everything is gonna settle? You need that clarity, and so every business is holding off. They're tightening things. They're battening down the hatches. They're going to lay off all of the excess employees to make sure that they can bunker up and stabilize their balance sheets and income statements and get everything stable. And this is not an environment where companies are growing. Now, on the other side of this, once there is clarity, then this will end up being a phenomenal buying opportunity. But we probably are going to first have a recession and some kind of a contraction in earnings. And as always, there'll be a buying opportunity on the other side of it. But this is likely to last into the summer at minimum.
Yeah, I would even be more bearish than you about the buying opportunity, because I think the damage being done is more permanent than you do think. Like, let's just take for example, one second. Let's just think about what Nutlix did recently. He was sitting there and he said, all the money that we promised you for the IRA and the CHIPS Act, well, if you don't pay even more, we're going to withhold that. If you don't invest more in our country, we're going to withhold that. So think about that. He is extorting companies that were already investing in the U.S. because of the previous policy. Does that make anyone want to go and say, yes, that's great, I'm going to do more? Not a chance. The damage that is being done long-term from these sorts of behaviors and threats and policies and everything is just way worse than most folks realize.
Okay. We got to move on. Okay. I think our point is there. Here's my view is this. It's a very good chance S&P is going to struggle to spend any sustained period above 5,700. Even, there's always going to be maybe one thing that causes a 3-day pop up to 58 or 5,900, but it'll be very quickly faded. I think the vast majority of the price action stays below 5,700 before the market rolls over again. But let's talk the dollar, because we can't not talk about this without this huge move that we're seeing. Now, I was back in February bullish the dollar. I was bullish, and it was obviously because I was using the wrong color of crayon. I somehow was using a green crayon versus red, and my it caused me to have a tilted view. But basically, I abandoned my bullish stance once this breakdown happened on the dollar. Like once we got that first wave of selling, it was the fact that it never recovered from that selling. Immediately was demonstrating a massively negative price action, distributive price action, everything. As a technician, if you don't have a bias, you have to say that's shit.
And you did. I remember you saying that. Yeah. Kudos to you, because it pained you to say it, but you were very much like, no, this chart looks like shit, and you were correct.
It did. And one of the things, just based on the basic rules of symmetry in markets, there's a famous technical analysis saying that basically is that flags fly at half mast.
Oh, yeah,
which is essentially, which is basically you take the length of the first drop, and the next drop has a similar length. It's always in that manner. Point is that all along it was sending the dollar for a retest of the 100 zone on the downside. Now, that was just based on technicals, and when that flag broke, that was the only way to technically interpret it was below all its moving averages. It was being distributed, negative price action, breaks to a lower low. Like you have to respect that was what's going on. But what's crazy to me is this was on a percentage basis from peak to trough on the dollar, 10% decline.
Yeah.
And 10% is a lot, but it was just a 10%. But you got headlines out there that the market is reassessing the dollar as the world reserve currency undergoing the process of rapid de-dollarization, and it's this kind of almost like panic out there.
Doom at 11.
Doom at 11.
Well, I'm sure that on some other podcasts you're going to be quickly talking about the de-dollarization and the end of the world.
So what I want to highlight is back starting in 2017.
No comment.
There was no comment. I'm going to just shut up. There was a 15% decline in the dollar in this past wave back in 2017. Back over in 2020 on COVID, there was basically a 14% decline in the dollar. And after the 2022 bear market got underway, there was a 13% decline in the dollar. The point is we have not yet seen a dollar move that is even bigger than the dollar bear downtrends that we've seen in the last decade.
I would agree with that.
So the point is that when you know, I had that great interview with Marco Papich, and he was obviously referencing the bear markets. Here, I'll just put on a monthly chart of this huge bear market decline in 2000, right over here. First of all, I want to highlight the Reagan drop in the dollar, right? So the dollar index back in the Reagan era was a 50% decline in the dollar. That took a half a decade, but it was still a ridiculous drop. And then you had the 2000 to 2007 drop, which was a 40% decline in about a 7-year period. And each one of those periods was not the end of the US dollar as the world reserve currency. And for everybody that is already trying to call this like some devastating drop, we haven't really broken below levels we have seen back in 2023 and 24 yet. Like we're not.
Forget about that. Like this is like when Kamala was running, we were here almost.
Dude,
like when she looked like she
were
win.
here. We were here 2 months before the election.
Yeah,
right. Okay, so now that doesn't mean the dollar isn't going lower. I just want everyone to hold their horses on calling doom, like that this is all.
Hello, pot. This is kettle.
Yeah.
You know what? You don't like people calling doom on the negative side of the dollar. That's what. If everyone was calling doom and that there was going to be a huge dollar rally because the world was ending, you would be all for it. But because this is doom on the negative side.
No. So here's my deal. It is entirely plausible with the way that this price action is behaving and the macro geopolitical shift we're seeing, that some new prolonged US dollar bear market can easily ensue. And this can be much worse. But when we're talking a real dollar bear market going down to the Dixie down at 90 and 85, we're not talking it returning back to 100 as being the downtrend. If there's a real dollar move, it hasn't even begun. Maybe this is the second inning of first and second innings.
I think it's first. I think it's first inning.
That's it could be, and it could be.
Yeah.
But what is going to be technically important to me? Right now, I'm going to make a call right on the show.
Okay. 2 calls. This will be your second one.
Today, that drop that we're seeing, that's going to be a short-term low on the dollar. And what I mean by that is that it's not an intermediate or long-term thing. And it's not a bull market in the dollar. It is not going to be that the dollar is going to be in a bull market. It's simply that this has now come down to key support lines down below in a very big puke to the downside, no different than it felt on Monday on the stock market. And this has gotten overshot, and there's going to be a bounce. That's all I'm calling for is a bounce.
So I Patrick, think you know why it's not going to work?
Why?
Because I've just almost finished my piece about the US dollar, and I came to the same conclusion.
Oh my God.
So you're screwed, buddy. You're screwed. This thing's going to slice through 100 and just keep going because I said the same.
We can't both be right.
I completely said the exact same thing, that I was like, longer term, I think this is headed much lower, but the trader in me's got to trade. And I feel like I'm
buying the dollar for the bounce. It's a technical trade. It is a short-term trade.
Well, I'm not doing that. Because I believe Dennis Gartman in his things about like in bear markets, you're either short, really short, or flat. So I can't even bring myself to no longer be
Yeah, but see, the
Just
problem
I have
is
to
that
go with
you
short.
just gotta learn. You gotta just learn to use options because
No, I
you
only have
can.
options on this.
Well, come on, then you're not Delta One equity here or a currency.
I don't care.
Like
I don't want to give it away because if it slices through, I'll never forgive myself. I got to stay a little short. I brought in
Okay,
some,
all
and
right. Anyway,
yeah,
that's enough. We made the
okay,
call. We made the call. Let's both of us agree, which means it's not going to happen.
yeah,
So everyone now knows. Just keep shorting the dollar because
yeah. It's
Kevin
gonna
and
slice
Patrick
right through it. Yeah,
market gods are going to separate us from our money, and
yeah.
that's the way it's
Well, no,
unfortunately
I'll still make money on the way down. You won't.
I
Anyways,
won't.
go on.
Let's talk. We're talking really long, so we're going to have a few assets. We have to talk bonds and gold, and then we'll leave it at that.
Okay.
So gold. What an epic rip! Now, again, we called a breakout trade on gold 3 days ago on Tuesday, and it came right to the Fibonacci retracement, right to the 50-day moving average, and we leaned into it. But what I'm shocked about is how fast this rally happened. Like, so to me, the technical level on the downside was something that could be called, anyone who just buys the 50-day moving average test would be in with me, right? Like, this is not some crazy call, but what is crazy is how fast that move is. And so now, Kev, we've talked about parabolic markets before, and this is you're going to give your $1,000 up week rant in a second because you love
it's getting old. I got to stop saying it.
No,
Everyone
no, no,
knows
no.
it. Everyone knows
Dude,
it.
stop. Yeah, stop
Well,
gootering it for yourself because it's literally setting up. And so what I want to highlight is that we've got an acceleration of slope. Like what's happening here is that the rises are becoming more rapid and faster, which is typically the shit you see when things go into bubble phases.
Yeah.
And this, like, okay, there is a short-term measured move right here at 32 to 3,300 where short-term traders that are trading gold here are supposed to be taking profits. If gold rips through 3,300 like a hot knife through butter, it ain't stopping until 3,600. And then who knows what the fuck will happen after that. 30, but
you're bulled up, buddy. You're bulled up. I'm not getting in the way. I'm just gonna keep my mouth shut.
All I'm just saying is the test is right now. This 32 to 3,300. If this was just like a small little prairie dog and it fades right back down, it will fail right here into 3,300. If it and I think that the real tell will be if it rips through 3,300, it means somebody is freaking buying this thing indiscriminately at any price, and this thing could just rip, just like it just.
I don't want to go through your trade. I'm just going to observe one thing.
Mm-hmm.
Ever since 2022, when the West zeroed the Russian reserves, I have been counseling everyone, stop looking at rates, stop looking at the US dollar.
Central.
It's trading, gold is trading on something completely different. And I just keep saying it and saying it and saying it. What I think is interesting this week is gold was trading inverse to US bonds. Inverse,
and
Patrick.
Dollar.
No, the dollar was going down, and but it always trades inverse to the dollar. That's not. But I'm saying in terms of bonds, and my point is this: I've always, counseled that the Chinese are going to diversify their foreign exchange reserves into gold, and that is the reason to be bullish gold.
Yep.
What if this, Patrick? What if this week, when the shit hit the fan with the tariffs, China was selling bonds, and I do believe that they were selling. I'm sure other people were selling too. It's not like I think it's only China. Japan was selling. There's also some worries about the economy being stronger than expected. There's a million reasons to sell bonds. But what if the Chinese were selling their bonds and panicking and buying gold?
Yeah.
Think about that for a second. What if they're trying to get out of that asset that they're scared about, treasuries, and increasing the asset that they want to own, gold.
Yeah.
That's like mind blowing. I'm like, like that's,
dude.
I think that could be
Oh,
happening, which I think is fascinating because that means
yeah.
bonds going down, which, in
Yeah.
traditionally would mean rates going higher and that everyone should sell gold, is actually the opposite. Bonds going down means that there's going to be more money buying gold.
Yeah. Okay. I'm not going to say anything else. We got to move
Okay.
on before we
Okay.
get ruin this for everyone.
Okay.
Okay. So the next thing, by the way, the one thing that we did on gold is I had a collar on it to protect it. We had to basically kill the short calls before they got in the money to open up the upside on the collar. At this moment, I'm standing on one view that it's better to spend money just on outright puts and hedged it out and leave the upside completely open and don't sell away the upside potential, because this is now when gold is getting spicy and you got to leave it open. And that's that. So I do have a lot of members that are hedged on gold, but no longer in a collar format. They're spending a little bit of their profits to buy that tail, but the upside's open. I want to talk about crude oil. What a fucking dump! $17,
Yeah.
or was it more now? It was basically, yeah, it was like a $18, $17 decline and 25%, like just like that. Now, I want to talk to this inflationista that's in my presence, and ask you, while the transitory impact of higher tariffs and disruption of supply chains is for sure going to cause prices to rise from that on the interim, but when you have almost every commodity wipe out 20% outside of gold on the downside, at what point is there outright kind of offsetting effect where the disinflation of the one offsets the inflation of the other, and inflation will be far more benign?
Well, so first of all, you are correct. Like if you go look at the inflation swap curve, 1 year inflation spiked higher, 375 or was 375, and 10 years going down. You actually had a situation where the market was anticipating that we would have an inflationary spike followed by a deflationary force over the longer term. So I'm not going to deny that. What I think that the market is missing, Patrick, is the fiscal response from the rest of the world. And I think that fiscal response will be way higher than most folks anticipate. And we are going to be shocked at the bull market and commodities that developed.
I agree with this, but the question though that I have for you, does it start with the ECB already, like next week?
Not the ECB. It's a fiscal response. I don't care what the central banks do. Fiscal response. We need fiscal response. So we need governments to do it. And that's unfortunately what happens is that fiscal takes a little bit longer. It has to work its way through the system. People get excited by the initial announcements, and then they want it all to come immediately.
Listen, I'm going to let you stop talking your book because you ate it on your oil trades. Okay. So like,
but you know what? Actually, the one thing is I bought December Brent, and it actually didn't hurt that much. Like, go pull up December Brent. No, honestly, like December Brent, like I was like looking at it. I was like, because I don't know why I think I think there could be some weird stuff that happens in WTI. So I've never been bullish WTI.
Okay. So it went from 74 to 62.
December Brent? I don't think you got that right.
Well, this is the December 2025.
December Brent. Well, maybe it was much worse than I thought. See ya.
I forgot to look at my account.
No, but you know what? The reality is I was short so many other things that didn't hurt. That didn't hurt as much as I thought it was.
Anyway, the point I want to just highlight is this.
It was $8 on, so it went from 70 to 62. $8. Listen, the world was coming to an end. I'm fine with that. Like I never expected to win on all of them.
So my concern right now is only short term, because I also am in the camp that there's going to be in the second half of the year a great commodity bull market. But when something looks this shit and is this bad and this correlated to risk assets, my only concern, it's just a concern,
Yeah.
that it could take months for this market to stabilize and base in order for it to set up in any way to make a bull move. Like at this stage, I would be shocked if by June, July, the charts were turning up.
Okay, I'll take the other side of that. I'll bet you that by June or July that I'm back on side on my trade.
Well, first of all, I'm looking for a bounce in all risk assets. So I think, for instance, the CL contract here is going to be at 66 or 67 in the next week.
Okay,
so there's going to be a bounce. So for you to make a call that you're going to be flat on the trade is kind of
okay. I'll tell you what. I'll be on side. I'll be on side from the high tick, even though I didn't pay the high tick. So the high tick is $72.
All right. Okay. What do you want to bet?
Crude.
What do you want to bet? I'll bet you. What do you want to bet?
Well, listen, I need some odds because look at it. It's like I'm calling for a $10 rally.
Here's what's going to happen.
Yeah.
You're going to set up for the next episode. Yeah, price out some sort of a fair bet on this, and then we'll put some beer on this. So one of us is going to take some members out for a dinner or something like this. Let's make a bet that matters. All right.
Because like I already have a bet that matters. But anyways, we'll figure it out. We'll figure it out. But my point is, I think you're much too bearish on this. And not surprisingly, by the way, go look at the Commitment of Traders report. Everyone is super bearish on this. Everyone. Okay. So I could see this thing surprising to the upside huge.
Okay, but my short-term concern is the oil bounce was literally shit in compared to the stock market bounce. That we are not seeing that reflexiveness that would normally come when something is so cheap that there should be that snapback bungee cord snap the other way. It's disappointing that oil didn't show it. That's the only reason why I don't want to drink your Kool-Aid. Okay. Let's
what makes the market.
Yeah, look. I when oil turns bullish, I'm going to go long. Like I'm not in any way trying to shit on your idea. I'm just saying it's going to be later in the summer. Let's just finish talking about bonds and we'll have to wrap.
Okay.
First of all, congratulations on you separating me from my money on the long bond. While I actually have been calling things fucking to the T on this market on so many fronts. And I was making money hand over fist on so many things until bonds. Yeah. I got this one spectacularly wrong. Now I was right up until the first few days of April, I was making shitloads of money on this trade. I thought it was fantastic. And then this whole basis trade clobbered me instantaneously. What a spectacular reversal in the long bond. Of course, I need to hear what now the bearishness that you want to say. Go ahead and give.
No, I don't need to. It's talking for itself. I think it's headed a lot lower, though. I think that it'll be the surprise. Everyone's going to be shocked at how bad bonds trade.
Really?
I've continued to say that. Listen, this is.
But you're not talking short. But you're not talking short term, because I think short term interest rates could go lower, like the 2-year, like the your TUA ideas and shit.
Well, the trouble is that's got a lot of cuts built in now, right? So I'm not even sure that works anymore. And the reality,
I actually think that the market is mispricing how dovish the Fed will have to get in the end. I feel that this is going to get to a stage where Powell is going to have to get outright dovish.
Okay, but here's something to think about, Patrick. Let's say that the selling continues in the bonds, and we can agree that the selling is unusual considering how bad stocks have done. Usually you would get a situation where they should be rallying. This should have been a huge rally in the bond market. Instead, it was a complete just disaster. So let's assume that China keeps selling, Japan keeps selling, it ends up being a problem. And next thing you know, there's actual problems in the bond market. That ties the Fed's hands. traditionally in an EM situation, when the bond market goes no bid, what you want to do is you actually raise rates. You don't lower them. So this is the problem, is that the US might be shifting from a behavior that is typically, DM, where everyone buys the bonds because they expect the rates to lower, to a situation where money is leaving the country so fast because of the problems with the government and the policies, that you actually can't lower rates.
Yeah.
So I had a really smart guy the other day talk to me about, he says, I'm actually pricing out some SOFR Fed rate hikes because they're so cheap with the skew and things like that. And listen, he's not saying that's going to happen. He's just saying that there's a potential that does occur, and that we have so much problems that we need to raise rates, or the US needs to raise rates to stop the flow out of it. It's a low probability event.
Yeah.
The good news is the options are priced for it to be an almost a zero event. And so you can make
there you
money.
go. You get buying that insurance on the on that tail. I get it.
Yeah.
You know what? But okay, so here I've got the 2026, the 3-month SOFR futures out to December 2026. So we're talking about rate cuts between this year and next year. I mean, we were at the stock market low. We saw a temporary rise above 97, which is below 3% on the rates. And the market has materially mean reverted that. We're now back to 96.60. I think the steepener is the bigger trade than it is about broad markets, bond sell-off that right across the whole curve. And if anything, I think we could hear things like Operation Twists come out of the mouths of some officials and stuff to try to manage the long bonds. But I think that the stimulating of the interest rates on the short end, I won't be shocked if we say sustained above 97 for a while, and maybe even head to 97.5 at some point. I think buying the dip on these SOFR futures is something I'm going to be looking at doing in the weeks to come. I'm flattening my trade when the thing popped. I mean, I'm interested to play this at some point. I'll tell you when I do it, but right now I'm flat. But I think that this thing could head north of 97 again, with and maybe even higher, 97.50 or more.
Well, the only thing I like is the fact that you're no longer doing this in the long bond. If you're going to do this, this is the place to do it. If you're going to bet on rates going lower, don't bet on the long rates. Bet on this one. So I'm with you, Patrick, at least on that side.
All right. I think that's enough for today.
All right. Thanks, everyone, for tuning in. We really appreciate it. Patrick, if they want to find out more about your great service and all these terrific calls that you have, where do they find you?
You can find me at bigpicturetrading.com. And Kevin, where can they find that fantastic newsletter? By the way, I loved your piece explaining the but we never really even talked about it too much, the basis point trade, but you did
the basis trade, not basis point
basis trade. Basis trade. And you did a great piece. I really enjoyed reading it.
Oh, thank you very much.
I think that
it's nice to see you read one.
I rarely read your pieces.
I know. He phones you up and he goes, "Oh, listen, I have some questions about the basis trade," and I'm like, "Oh, geez, dude, do you not check your inbox?"
But those of you that don't subscribe to Kev, I'm going to give him a shameless plug. He did a great piece on that, and it's worth reading.
All right, they can come to the macrotourist.com and check me out there. Listen, bear market, bull market, we're just happy to spend some time on this crazy ride. So now stick around for the after show. All right, Patrick, you got to review your beer. The Stubby.
Well,
by the way, the Stubby.
The Stubby beer. I intentionally bought it because I wanted the Stubby. It's
guys, you don't have to set me up for that joke that I didn't say earlier.
I was trying to. He got mad at me. He goes, "You walked all over my joke." So I'm like, "Okay, well, we'll set it up." And then we tried to set him up. He goes, "Oh no,
he doesn't want to do it."
I know.
Now he doesn't want to do it.
Yeah,
all right,
not even funny.
He's so sensitive.
Absolutely.
This is the trouble about this next generation, Patrick? They're so sensitive.
What can I
Absolutely.
say?
So I would say that this is a incredibly average beer. For the fact, no, but like I had nothing bad to say about it, but there's absolutely nothing good about it either. It's just like a clean drinking. It's a perfect for the nice weather outside. It's one of those things you could sit outside and have a beer. I'm actually just gonna give it like a 5.9.
Whoa.
Yeah,
He's
it's
That's
like
tough,
low.
man. He's tough. He's tough.
this is just a grocery store beer. I'm not going to rate high a grocery store beer. It's I'm just not
Wow.
going to do it. I'm not going to do
It's
it.
tough.
But did you turn it upside down like they said? As you know, is
I
that,
did for a moment.
maybe
I
that's
gave
it.
it. I
Yeah.
gave it the flick.
The
Gave it
flick.
the flick.
Okay.
Okay.
The flick. What do you got planned in Mallorca? Is that how I say it?
I'm going to say Mallorca. Yeah, and I'm just going to check out the island. It's going to be awesome. It's my first time here. Like I've been all over Spain, but I haven't hit these islands, and so this is going to be a weekend of exploring the island for the first time. It's going to be awesome. Looking
Oh,
forward
that's
to it.
great. Have you been,
Yeah.
Daniel?
No, but my partner is from Mallorca.
Oh, she is.
Yeah.
I helped you out there, but
Thank
she
you.
is from there.
Thank you.
Wow, I didn't realize that. So she's not English. She's actually Spanish.
Yeah.
Oh, I didn't realize that. Wow. So why haven't you guys gone back to her hometown?
No interest, right?
Yeah. Good question. Maybe Pat, if you explore it first, let us know, and then maybe.
Well,
we can
you know what?
go.
The one, no, what's so crazy was that I didn't download the taxi app when I was getting here. I didn't know what taxi app to use, and so I figured they have Uber, and they do have Uber, but it's like a luxury rating type thing on it. So I was downtown for lunch today, and I had to get back to do work for the market open and stuff like this. I couldn't freaking get a cab. Like I'm like waving 7-8 cabs. I'm running in front of them. They're no. And I go try to order an Uber. It's like a 20-minute wait. And it was like a ridiculous price. And so I started waiting. Then it's like, fuck it. I'm going to go to the hotel and grab a cab from there. I cancel. I come back. The price of the Uber doubled with another 20 minutes on it. Like
Wow.
it took me an hour and a half to get back. This is the little things. Like I love places where it's easy to move around. It's easy to do shit. Like my first experience, maybe it'll get better, but like I'm only been here for a day, but this was quite irritating. I have to say,
God,
I'm agitated.
you are just
I'm agitated.
like you are looking like a spoiled North American with shit like that.
An hour and a half, dude.
Like, you know what?
I could have walked. I could have
Relax,
walked.
have a drink, enjoy the weather.
That's
Why
it,
are you in such a good
you know
rush?
You know what? I am gonna have a drink. You know,
Yeah.
they have the most wonderful vermouth here in Spain, and I'm gonna crack open some vermouth, and I am going to enjoy
Wow.
Spain.
Well, you
properly.
do that and get your bitterness out of you, and you come back with a better attitude.
Anyway, but listen, Kev, great job on what you did for Morris. It was a fantastic piece. So thank you very much. I appreciated listening to it.
Oh, well, thank you. And we'll all miss Morris. And
Yeah.
just thankful for all the memories that we have with him for the Market Huddle.
He's always going to be a legend on the Huddle, bud.
Yeah, we'll all miss him.
Yeah. All right, guys. Let's
Take
call
care.
it a night. All right. Take care, everyone.
Bye-bye.